But if it was March 1st, they'd give us a share price, we'd adjust it to fair value, then we'd change. Okay? Now, this next step then, we can transfer investment and fair value through profit and loss and transfer it into investment. So that's what we're going to do. We're going to transfer investment from fair value through profit and loss to associate. Sometimes the problems expect you to do it, sometimes they don't. You know how each entry it'll tell you what to do on the top? Just follow that. In reality, we would probably transfer because they'd be different account numbers. Setting, as long as you know you're switching methods, it's understood you know that. Okay, so we have to switch and close off investment, fair value through profit and loss, and create a new account. Investment in associate. But we need to know the balance first. So what's our balance? Plus the 5 gives you 320. Excellent. Okay, everybody good with what we did? Okay. Now comes the actual equity entries. So, with a fair, either through profit and loss or OCI, you always record dividends. Why? There's actual cash changing hands. It's not an adjusting entry. Okay? So dividends are always recorded. Later, it could be cash or accounts receivable, dividends receivable. But for now, we'll just leave it at cash. Then you adjust it to fair value. But with the equity method, and in case you haven't watched, so the equity method, we've got some significant influence for whatever reason. So it's like we can affect their decisions, okay? Like let's say I own 18% of that business across the way. I'm a company, I own that much. But all the other shareholders, no one owns more than 1%. Do I have a little bit of power? Yeah. So I can influence because I can get my shareholders on the board of directors. Here I am, and it's like this other company is like kind of attached to me. So when a company in general, gives dividends away, thinking of what happens to their balance sheet, is it good or bad? Bad, right? Because it's dropping. Retained earnings is dropping, and so is cash. Now, it's a great thing to do, and there's nothing wrong with dividends. So that means our little investment in that company, it's kind of taken a hit too. So when our little attached company, our associate, gives dividends, we reduce our investment because it's like they're part of us. Ooh, our balance sheet went down. Okay. On the other hand, this is totally kind of, you haven't done anything like it before. When this, lost my train of thought, I've been doing it all day. What was I talking about? Was anyone listening? I wasn't. Oh, right, the dividends. Right then, net income. Thank you. This little company earns net income. Well, is net income good or bad for a company? Good for our investment. So net incomes are going to decrease our investment. So that's what we're going to work with. So let's go on to the next page and go to the end of the year. And this is equity method. And it is December 31st, year 6. Okay, so we said there's always two things. Net income. So we're going to record dividends first. So what are we getting for dividends? Cash, right? Now, if it was fair value, we'd put some kind of income account. However, we have influence over this company, so in the same way, it can kind of, its performance affects our investment. So, we are going to reduce our investment in associate. And it was 40,000 times 2, so it's 8,000. Does that make sense? Excellent. So then the next thing is net income. Now, in this case, if you look back, I'll just put this back for a sec. They earn net income in year 5, but we're not in year 5, so we don't care. And so we've got to record that 90,000. So we've got 90,000 times 0.2, which is 18,000. Now, if dividends makes our investment go down, what will net income do? Make our investment go up. So we're going to debit investment in associate for 18,000. So now that represents income to us. We're actually going to record income on our income statement. So we're going to call it equity income. In reality, it could be called income from associates, revenue from associates, something like that. Key thing, it's an income account. But I believe Connect is fairly consistent and the solutions on equity method income. Now, just so you guys know, with the CPA, when you're in those programs, include all the way up to the CP. So Capstone 1, Capstone 2, and then the CP. They're looking at competencies. So unless they use is absolutely rare, I don't think I've ever seen it. They're looking at you just understanding. So they're not as picky on wording. So, for example, for this, if you called it something else and you had the word income or revenue or earned, you'd be good because they want to know. Oh yeah, they know it's revenue. Okay. So when you're doing these entries, because of course CPA, once you get there, they've softened a bit. I did the first, around the first session. Oh my God, my mind. You had to used to come in and do weekends for each module. And I did the first Core 1 module that was ever offered. I was doing it in Calgary. And what they expected everybody to do, well, it was insane actually. It changed very rapidly in the next. But they expect you to know entries and everything. So don't, as you're going through these, don't try and memorize, piece the entries together. Then you're kind of guessing, right, for what's left. Like for these two, and I stress these in particular because we're going to keep adding to them, all these little tweaks. So here, well, you know, Is cash coming in? Always, when you've got an entry, is it cash? That's the first thing you look for. Cash. Okay, then you say to yourself, okay, I credit something. Is it an income? Oh no, it's equity method. It's too close, means it's got to be the investment. Then same here, you know this going up, then you got to guess at the other one and reason your way through. Okay? So kind of practically, you'll get better at it so that you're not just really slammed. They're a lot better now. They have, they do a little bit of review and a little bit of practice in Core 1 and then Core 2. So it's good. Okay. So should I mark it to fair value now? No. So make a little note. No fair value. And we're going to go back to the other page where we had dividends. And what am I missing? No income. So no net income here. So that's the difference between the fair value methods versus the equity methods. So just little things to trigger your memory. Okay, so we know no fair value. So what's the very last thing that happened at the end of year 6? Baskin sold the investment for 17. So first we need to know what the balance in the investment account is. So third thing that happened, sale of shares. So we'll draw a little T account, investment, associate. And we started with 320 in there. We reduced it by the amount of dividends and increased amount of net income. So that works out to 330. You good? Okay, so you did sale of financial investments in 315 and 311, I think. Well, you did sale of anything. So try the entry. And think it through, right? You haven't seen it, but you know what you're doing. Oh no, I hope not. 320 from this last entry where we transferred it in. Did I do my math wrong? No. Okay. You never know with me, you guys, on the next question. I kept screwing up the number of shares. Okay, so let's try piecing it together. Room for debits, room for credits. Getting. Cash, right? So cash, 20,000 times 17, which is 340,000. What's leaving? The investment, right? That easy, you guys. You thought it was a trick question. So we got to close off the investment in associate. 30. So we're done, right? No, what are we short? 10,000, and what's that gonna be? Perfect, gain on sale. Notice this is not unrealized because we're actually making the sale. Questions? Okay, that's the end of this question. What we reviewed is fair value through profit or loss and the equity method. And the equity method, I suggest maybe keeping somewhere, if you're taking notes electronically, in a separate file or on a separate piece of paper or something. Start keeping track of dividends and net income. Then I think it's chapter 4, it might be 5, we add another entry. So then you'll add it on every chapter until we're done. And then you'll have a sheet with the whole thing on it. I mean, I usually do kind of review it as we go through, but that way you can keep looking at it. Okay, so equity method, what are the 2 entries? During the year? Without looking at up or down? Dividends and net income. And if it was a net loss, what would it do to our investment account? If this was a net loss, reversed, right? Yeah, perfect. Okay, and tell me, with fair value through profit or loss, if I change this to fair value through OCI, what would change on here? There's one thing, well, besides these letters. Sorry?
Like if they got less control than they had?
Still switch. If they got more control.
Less, though. It would go to OCI.
No. Good thought, though. OCI and this can be used kind of interchangeably. Not interchangeably. When you first buy the stocks, you make a decision. Once you've made the decision, it's irrevocable. So it doesn't matter whether it's going up or down. Now, if it was going down, we'd like to get an OCI, right? Because it doesn't, but that would mean we flip-flop back and be a good thing. So, there's one account that's different here. Maybe I should have been clearer. Sorry about that. One account. The gain. What will it have after it? OCI. That's it. That's the only difference. Okay? Everybody good? 2-2. It gives you a good overview of what you need for this chapter. Now, 2-5 is the different kind of question. Because if you look at what's required down here, they just want balance. Balance in the investment account, how much income will be reported. They don't ask you for any entries. Thrown off because they try and jump right to these balances, but you have to think through the entries first, okay? So, some people are really good. They can easily go to the balances and understand. Some people, like anything, right, have to go through the entries, then post them and go, oh, that's how it works, okay? So I'm going to talk you through some of this, and hopefully it'll make a little more sense. So, just to get started on here, her company purchased 22,000 common shares, 20%, January 1st, year 4 for $3.74. So it's always nice to have the per share price, so I always calculate that. And of course, you guys don't have to. $3.74 by 22,000 is $17 per share. Sorry, that's a little tight there. The other thing I wanted to do is, do we want net income And dividends at their total amounts? No, we want them at 20%. So I'm just going to do that a little. So I'm just multiplying everything by 20%. You should get 44,000, 49,500, 52,800. And that works out to a total of 146,300. And then here, 33,000, 35,200, and 38,500. So we've got year 4, year 5, year 6, and again at the end of year 6, they sold the investment for 506. So, what they want in Part A, compute the balance in the investment account. So investment account at the end of year 5, assuming the investment is classed as FVTPL. So we're going to start. Actually, why don't you guys take a second and figure it out? Or try and think your way to it. Many ways you can take to do this. You can just do a calculation. You can start with year 4, do the entries, do the write-up. Year 5, do the write-up, see what the balance is at the end. Lots of different ways. The more you practice doing them, though, if you don't already see the easy solution, you slowly will. You go, oh, hey, wait, I could have just done that. That's why I suggest if problems like this, where they want an end balance, practice doing the entries first. That's okay, because you'll start seeing patterns. So on this one, for fair value through profit or loss, what do we do at the end of every year? Mark it to fair value. So at the end of year 5, if this is the fair value price of the share, do we care what happened before? No. So you can take a nice, you can say 22,000, right? That's going to equal the number of shares times the price per share at the end of year 5. So it's simply 22,000 times 20 is 400,000. No, it's 440. I can't read my own writing. Everybody good? Okay. You're not wrong if you would have done it the longer way, but you've got to work on doing that, getting your speed up so that you can see the pattern so you can immediately go, oh, I just have to do that. Okay? I'm going to jump to fair value through OCI now. Now, what was the difference in the methods, those two methods? Are the entries pretty much the same? Do you mark it to fair value every year? Except the gains or losses all go into OCI instead. So, what's the balance in the investment account going to be? Any different? The same. So, same as fair value through profit and loss. Only gains and losses go to OCI. So equals 440. Now, with the equity method, I know we just know, you can just continue here. I'm just going to do it over here. What are the equity method entries again? There's 2 every year. You guys are going to be so sick of me asking this by the end of December or the middle of December. Dividends and? Perfect. So dividends, we debit cash and credit what? Investment. Good. At least I thought I heard someone say it. And net income, we debit. Investment. Oh, can't spell. And credit. Some kind of income account. Equity, method, income. And that stays consistent through this whole text, but wherever you work or whoever you're auditing, it's going to be called something different. Okay, so keep those in mind. So here now, part 2, they want equity method. So basically, to find the balance at the end of year 5, does it matter what happened in year 4 and all the way through year 5? Yeah, it does, because we're not just marking to fair value. So we're going to have to start with beginning balance, year 4. Add net income, year 4. Subtract dividends, year 4. Add net income, year 5. And subtract dividends, year 5, to get the end of year 5. Now, again, you could do the entries first and then post into a T account. That's totally fine. So, go ahead and do that. I'll put these numbers up so you can look at them. And if you have any questions, just wave and I'll come over. So you should get $399, $300. Yeah, excellent. Any questions with that? Where I got any numbers or anything? Okay, let's go to part B then, because that's focusing on the income statement now. Now I'm going to let you do fair value through profit and loss and fair value OCI pretty much on your own. But on the income statement, what's going to go into net income from fair value through profit or loss? And if you look at the last question, problem 2.2, we did fair value through profit or loss on the first page, if you forget.